Hello, and welcome back, guys. After some nice vacation, it's time to get back to business and take a look at a lot of companies. I'm gonna be making tons of videos in the upcoming few days, starting with Unity Software, which is a very interesting case because things happened about this around this company. And the thing that was most important is the fact that Unity wanted to introduce a new licensing fee. And we want to examine that and see what happened exactly. So, the most important thing out of this one is the fact that they wanted to introduce a flat fee of 20 cents per install. In case you are not aware of what Unity is, you can take a look in our module here in our company profile, for example, and find more information about the company and see that it operates in an interactive real-time 3D content platform. So it's basically a game development platform, pretty much, and it's a pretty recent IPO as well. As you'll see, 2020 was the IPO date, so it's just like a 3-year IPO company. We will examine what has happened in these past few years in regards to the company's stock price, which is very, very important. But you have to remember that when a company goes public, people, and that's stockholders pretty much, have a lot that they ask for. And they, generally speaking, ask for the company to be making more and more money. And so sometimes, a new CEO comes in, and in this case, a new CEO did come in, and actually they came in from EA, which kind of potentially tells you that they are really adamant about increasing the the profit that the company generates. And they had an idea of introducing an installation fee. So that installation fee is the one that I was talking about here, is at 20 cents per install, which means that if a user installs an application at any device, let's say it's a computer, PS5, Xbox, whatever, a mobile phone, then the developer would be getting charged 20 cents per install. And that's very, very problematic, as you can understand, because let's just say that you have pirated copies, or let's just say that a user installs the same application in so many multiple devices, like 10 devices, for example. So in that case, the developer, the company that's behind the game, would have to pay an exorbitant amount of fees. And the thing is, in some situations, especially when the amount of money that the company generates per user is not enough, the company could actually end up paying more than they are actually generating. And as you can understand, this had a lot of outcry. There was a lot of outcry out there in the social media, and developers got furious as Unity Engine announces new fees. And so, there was a huge outcry actually, and people were talking about it for days, saying that they would be moving to different engines in a move that would potentially make sense if these engines if these fees would apply. Because in some situations, even if you could be having some people, for instance, that want to like rage install an application and potentially even bankrupt your company. How do you actually prove that you're not an elephant in this case? And so, yeah, as you can understand, eventually Unity had to come back and, oops, that's the one I wanted to find. And Unity apologizes and walks back fee changes after game developer backlash. So what has happened there is that they came back saying that they are sorry about what they have announced, and they had an open letter to the community saying that now they have switched to getting a 2.5% revenue share or an install-based fee calculation, which is going to be one of the two, and actually the lesser amount of the two, which is a little bit better, actually significantly better than what was announced before. But with Unreal Engine getting about about 5%, I believe, in revenue share, that sounds better. Remember, this is 2.5% flat revenue. So if you're making, let's just say, $100,000 as a as a game developer, then you're gonna be getting some Unity is going to be getting $2,500 out of your revenue. That's not your profit. That's important to understand, because there's a ton of expenses when you're creating games, for example. In this case, that would be. But still, 2.5 is better than what they they announced before, which would be a case for potentially a company even going bankrupt. It would be outrageous. So the thing is that Unity is actually the top engine right now, and Unity, as you'll see, has a market share of almost 30% in game development market. Unity competes with 111 competitor tools. Some of the very well-known ones: Unreal Engine, for example, Godot, Game Maker, and again, as you'll see here, Unreal Engine 16% almost, Blender with 12.5. I thought Blender was about 3D modeling, but anyway. And yeah, I think there is some other tools here. But yeah, overall, the Unity engine is actually the one that is the highest in regards to market share. But now the important thing is this a buy amidst all these things that have been happening? If you take a look at the 1 year chart, you'll see that at some point the company was like over here, like the 1 year high was like $50, and before that it was even more, like almost $60 before 1 year, like more than a year before. And if you take it back 3 years, you'll see that at some point it was even almost $200 over here. So the company stock price has fallen off a cliff, like literally, and right now sitting at $31 with a 1 year high of 50 and highest being close to 200. As you can understand, this has fallen off a cliff, and understandably so. They wanted to make more money, Unity, that is, and this is why they announced this new licensing scheme. And because of the outcry, you can see here, like let's just say the 1 month chart, you'll see that it went down quite a lot. And now it's starting to come back a little bit after the company has announced that they are not going to be enforcing what they initially said. And so they're going back to 2.5% revenue model, which means that more than likely their revenue, Unity's revenue, is going to be better, net income potentially even better as well. But the interesting thing to see is, again, if you take a look at the 5 year chart, the company has been doing terribly, and the stock price has been going down and down. Why? We ask ourselves, and this is what we're going to be examining. And the first thing that we look at here is the foundational metrics, and the P ratio sitting at a negative value is horrible, frankly, and has always been negative. The company losing money in regards to their net income, basically not making profit, although they are doing a little bit better, and I do think that they will go in positive territory, especially after announcing this new licensing scheme where they're going to be getting 2.5% revenue, or something that could be even less potentially in regards to installs, one of the two. And the price to free cash flow also negative, even more negative than the price to earnings ratio. With outstanding shares going up, we have talked about it extensively. When a company is not making money, what are they going to do? They're going to either get debt or issue more shares. In both cases, investors are not happy, obviously. Sometimes debt can be good, of course, because it can be used to generate more profit. But in this case, it's not what has been happening, because as you'll see, the net income of the company has been going down, and with more outstanding shares, the people who actually bought Unity back when it was like 100, 150 got played really hard, unfortunately, because the company has actually diluted them extensively. Plus, they're doing even worse. So, bad things to see here. The only thing that's good is the revenue growth, but at some point, revenue has to translate to net income. And when this goes downwards, that's not a great thing to see, actually. And equity growing as well, but we do know the drill. It is growing because of the outstanding shares, because the company is issuing shares, and we will examine that right now, examining the statements of the company, the financial statements of the company. Not paying any dividends, of course, as well. They cannot afford it, obviously. And I want to examine the financial statements. You can kind of see what I'm telling you here. The revenue of the company has been increasing. It's not a company that's generating tremendous amounts of revenue, but it does generate revenue, and okay revenue for sure. But the thing is, after all the expenses are accounted for, the company is actually losing money. And actually, last fiscal year, actually they lost $1 billion, and losing more and more. This is something that we really don't like to see, and this is one of the core reasons why the stock has been going down, right? Because it's not generating money, and eventually, companies that are not generating money will have to go down in regards to their stock price. It will have to happen. There's no way around it. And the balance sheet of the company, you will see that it is going upwards, and you will be thinking why is that the case? And of course, we know the drill. I have talked about it extensively in previous videos. Additional paid-in capital is the drill, is the reason. They have been issuing tons of shares, 2.8 billion, 3.7 billion, 5.7 billion. And even though their liabilities are huge, and again, they're not making money, like their liabilities are quite a lot, their assets are more because of their additional paid-in capital, is what we are seeing here, and they are adding some extra debt as well. So, they are operating both ways, basically diluting shareholders and adding debt. It's exactly not what you'd like to see. So, we already know that buying this company, they will have to be super cheap for us to jump in. And the cash flow statement, understandably so, as you can guess, negative, of course, every year, because when you are starting with a negative net income, even after the adjustments for stock-based compensation and depreciation, amortization, and all the other potential cash flow expenses, eventually you end up in the negative regardless. And it's about the same story every year, about losing about 100 million in cash flow for the company. So not great to see, not great at all. And the last thing to examine is, okay, We do know that the company is not generating tremendous amounts of money. Actually, it's not generating any money, frankly. But there is always a potential for buying a company that is super cheap and be a little bit tolerant in regards to risk, like take up a little bit more risk for potentially more gains in the future. Now, the revenue of the company, the revenue growth of the company has been amazing. They have been making like 20% more, 30% more. You can see it here. The revenue growth of the company has been about, the 5-year revenue growth of the company has been about 30%. So I'm going to go high with this one. I'm going to go, let's just say 10, 15, and 20. That's for the next 5 years. That's a lot. And the net income margins, that's the problem with these companies. You cannot really tell for sure because they are losing money, right? So they're losing money every year. You'll see over here, losing quite a lot of money. But let's just say that the company eventually gets to positive territory. Eventually, they start making money. For this reason, I always like to use very low net income margins because they will tell me, okay, the company is about to become profitable. How much is it worth it to me today? If I were to be a little bit risk tolerant about it, and I wanted to buy the stock today, let's just say that in the next year or 2 years, they're going to be, in the red, pretty much not in the red, in the black, and pretty much start making a little bit of money. And the free cash flow margin that I'm going to be using, again, we cannot tell from here because the company has been losing money, so these are skewed tremendously. So we're going to go with something that's rather typical, 80, 90, and 100%. And the annual return, 13%, is the one that we typically ask for. And we do this, again, to examine what the company would be worth to us if it achieved marginal profitability. So if it suddenly becomes profitable, how much is it worth today? We'd calculate, and we'll see that even if the company becomes profitable, like let's just say next year, we're looking at almost $1 here, 2.4, not even $1, 2.4 and $5 for our high estimates. So what is the amount of margin that we have to get in order for us to make sense to be buying the stock today? So I'm curious, let's just examine 20% in terms of net income margin, 23 and 25. And it could potentially happen that we are near the 20s at some point. This is a software company, so maybe at some point, although they do have quite some expenses. But even then, even at 20% net income margin, we're still sitting at $11. And as you can understand, the company is extensively expensive today. And even though the backlash has happened, the company has lost a lot of its stock price, it's just not a buy for me today, and it's nowhere near being a buy. So I could see this potentially running because of the news, but it's a trade and it's not a long-term hold. I think that somebody who buys this for the long term could get significantly burned unless again there is some sort of hype that comes up in the future and people keep buying into this hype. But in regards to financials, this is just not looking any good, and I think I would avoid it for sure, no doubt about it. And I'll see you in the next video, which is going to be very, very soon now that I'm back. Thank you for watching, guys. See you soon. Bye-bye.